Welcome everyone to Housing Insiders from look, I just did it, Nate. That should make you feel better.
You
Don't you
said the
think?
housing insiders.
Yeah, because we were just talking about it. So everybody has to come
Oh,
over from the waiting room. So we always give like 10 seconds or 15 seconds for the waiting room
okay.
to become attendees. So welcome everybody to Now Next Later for Monday, April 21st. As you come in from the waiting room, we will get everybody. I kind of watch the numbers go from the waiting room to the attendees. So if you're ever wondering why we start a minute or so late, we just like that Zoom waiting room, and that's how webinars work. So again, thank you for joining live. We do post Now Next Later to YouTube after we record it. So for your colleagues or for your network, if you want to share something, always available on YouTube. But those of you who come each Monday at 1 p.m. Eastern to join us live, we really appreciate it. And I always say we watch the chat. So Lou, good to see you again. As always, thank you for chiming in and being a part of the chat here. Now, next later, I'll keep an eye on it for questions you might have for Nate. But in order to ask those questions, you got to know who Nate is and what he does. So let's start there. So Nate Denherter is the founder and CEO of Ardley. And Nate, I'll let you introduce yourself and Ardley. But if you could just give us some background, where were you before Ardley and what made you want to start this company? And then what does Ardley provide?
Yeah, thanks for having me. Jeremy, I don't do a lot of podcasts, so I mean I think it speaks to how much I like you that we're on here today. I get a little nervous about these things, but yeah, I was at my journey in the housing started at Fannie Mae, so I was there for 16 years before I left and started this company. Um, while I was there, I worked on some pretty interesting things as part of what we called the innovation lab. So that would be like collateral underwriter and the day one certainty program, things like that came partly out of my team, and so that was a really big of that. Plus, I don't know that little thing called the financial crisis that you might have heard about or read about in the newspaper. I was there during all of that, and so that was a really fascinating time. Learned an awful lot. And I think a few of the things that we did while I was working there have gone on to help the industry, maybe keep things like that from happening again. So those are some of the background that I bring to this. Um, then I started hardly about 5 years ago with the conviction that mortgage the mortgage experience could be better for borrowers and for lenders if they could take a better advantage of the data that they already have. And so, I started really hunting around for, where were the best sources of data that we could help people have that better experience with. And the number one thing I landed on was servicing portfolios. Servicing portfolios are really, really interesting. They have an awful lot of data, and they also, for a long time, I think the servicing area of the mortgage industry has been maybe a little neglected or thought about as just maybe an operational business and a capital markets business where you're going to have as big a portfolio as you can, spend as little money as you can servicing it, and there's kind of that's the way you make money in servicing, which is a way you can make money in servicing. But I also really I came to realize that the servicing portfolios that are out there, the people that have those are sitting on all the data they need to proactively make real offers to borrowers, offers that are really detailed, pinpointed, and maybe not perfect offers. If you lost your job yesterday, that's going to be tough. If your credit score has tanked recently or your mortgage isn't current, there are some things that can happen, but statistically speaking, those are not things that normally happen to people. And so, when you look at a servicing portfolio, some people see, hey, here's a bunch of mortgages that are paying every month. The Ardley team sees an incredible opportunity filled with lots of leads that are really, sitting there for free. And you should be taking advantage of those as much as you can. And so that's the thesis of our company. And the way that I can go into a little bit more about the way we go about that, but that's the anyway, that's what we're trying to do is to help people do servicing portfolio recapture as best we can, and we really think that at least what shows up in the numbers, lenders are able to get a lot of loans that way, and borrowers are able to have a great experience with a lot more detail up front than they otherwise could get and pre-filled applications. So that's pretty cool.
Yeah, this is pretty cool. I mean, you and I were talking about how we like to do, segments now, next, later, and I can't think of a more apt now topic than this because when we talk about rates dropping, and there's all these other shows that we know our audience tunes into throughout the week with Chrisman and others about rates. What's going on with rates? When are they going to drop? When's volume going to come back? But rates dropping and volume, quote unquote, coming back is only relevant if you can get it, if you can get it away from your competitors, if you can get it
That's
early.
right.
In some cases, if you can get it before your competitors. So
That's a really good
recapture,
point.
retention, customer experience, uh, data management are really, really hot topics for the right now, for this show, for this industry. And so with that, it does lend itself to this question of like, we won't even delve into the history of why it was so hard to manage this data and why it was so hard for banks and servicers. Let's assume that history for everybody that has dealt with it and been in the industry. Can you talk a little bit about how you're approaching working with a customer, servicing portfolio that is maybe, let's say, doing this manually or something like that? Just kind of walk
Sure.
through your approach of talking to a lender about what are those first few steps to getting
Yeah,
up.
sure. I think the big thing that we really try to emphasize with people is if you think about retention right now as defensive, like maybe you're buying credit triggers or you're, doing what you can to do warm handoffs from when people call in and have a question about their loan for their servicing, for instance. That we kind of think about that as playing defense, trying to make sure that you're providing as much, you know, warm handoff or good customer experience as you can. But in the end, it's really a defensive motion. And so for us, we say, hey, there's a way that you could take the data in your servicing portfolio, however big it is, and play offense. And what do we mean by that? Well, one of the things that we really spent a lot of time thinking about was when people consider their mortgage servicer. And I don't know about you, I have a mortgage. The main times that I used to think about my mortgage servicer were when I was paying my bill, which is not a time when I'm in a great mood. And the other one time a year is when I have to get that, I don't even know what it's called, that form that helps me get some tax relief, right?
Interest
Because of
deduction.
the
Yeah,
mortgage
that's
interest deduction. And paying my taxes and paying my bills are not, those are not times when I'm in a great mood. And so when we talk about defense versus offense, part of what we're trying to do with the Ardley platform is help servicers have more interactions with their borrowers where instead of the message being, oh, here I go, I got to pay my bill again, uh, as good of an experience as you can make paying your bill, I don't think you can make it good enough that anyone's going to be like, oh, wow, these guys are awesome. I think instead, what we try to do is we say, look, there's a way that you can uh, mine your portfolio and not just for, hey, this person's at 8% and the prevailing Fannie Mae or sorry, Freddie Mac mortgage average is 7%, and so we really should call this person, because that to me that's not enough because you may or may not be able to actually get that person a loan by the time you add in all the correct pricing, eligibility rules, and so what we really do is try to instead at scale take the servicing portfolio and mimic what a loan officer would really be doing on the phone with a borrower when they're trying to structure that deal. So if you think about what's in that portfolio, it's the origination credit score, it's how much the house was worth when it was originated, the timing of that, and then also how much is left, balance of the
Mhm.
loan. There's also escrow information. There's also taxes and insurance information. So all the information that you would need to get really close to what that person would actually be able to get in the real world if they were going to actually get a loan. And so what we do is we try to do that at scale every day when new pricing comes out for all the products we can find for that person, including home equity loans, and then allow our customers to proactively put those offers in front of people. So instead of that, you talked about, hey, rates have dropped, call now, or something like that that you were mentioning when retention becomes a really big priority for people is like, oh man, it's really a couple of big rate drops and everybody's leaving my portfolio. I better do something. This is more like, hey, wow, my servicer is really trying to be helpful and using the data that they have about me to let me know that I could tap this equity in my home, or I could get a reduction in my payment. And yeah, maybe I'm not interested in that this month, but wow, like I appreciate that they're doing that. And I'm going to think about them, the next time this email comes in, or the next time I see that presentation when I log in to pay my bill, or however it comes to you. But the point being, then if you can put that proactively in front of a borrower and give them the ability to go through a really pleasant customer experience when it comes to applying. What we find, at least the data that we're able to see with our platform, you are able to do a better job retaining your customers and make your retention numbers go up. And so that to me is the core of what we're trying to do is, we talk about, in the history of the world, I don't know if anyone's ever been on the phone with a lender that was offering them a great rate and thought, wow, I really should check with my servicer to see if they can do better.
Right.
I just don't think that happens. And the reason it doesn't happen is because people don't think about their servicer as someone that can do that. And so, an awful lot of people were told, hey, I'm your new servicer now, in a letter that came in the mail, and they don't even, and so that's not really like a sticky relationship. But if our point is, if you use the data you have and you try to be proactive about it, people will respond. And so that's the point of our platform.
Yeah, using so the couple things I'm hearing that I know, our audience is really interested in, and for me is the core to adding value to the relationship and to, like you said, beating the competition. One is differentiating yourself from maybe what would be a more typical experience in the now for a lot of servicers, which is one, I can pump in some home value from some home value engine next to the pie chart of your payment.
Yeah.
And when some really high level analytics hit, this person might get a phone call or should get a phone call. And what you're
Yeah.
saying is that's actually now out of date. What you need to be using technology for is running real time, real pricing analytics in the way that an originator, an origination side would look at this problem. And you're really bridging the gap between origination and servicing. It's for so long felt like there's a gap there. I think it probably still does for a lot of people. And one of the things that I'm hearing is, and then on top of all of that, you can proactively reach out to that customer, and whether or not they're in the market for a deal, they know they got something interesting. They got something more valuable than they've gotten before. Promo code, coupon code, whatever the
Right.
others are doing. This is real. And you mentioned something in the intro that I wanted to make sure we hit on, before we start looking forward. And that was a real offer. And I've been so obsessed with kind of this idea of proactive finance. And this is a real offer, not having an LE that sort of represents some hypothetical numbers that the person on the phone came up with, but is this still true? If it is, here's your price. Is this still true? If it is, here's your price. Can you
Yeah.
talk a little bit about how Ardley approaches that and how you built the experience?
Yeah, sure. So, I mean, I think at the core of what we do, it really means combining a few different things that for a long time in the industry have been pretty disparate. So, one is product and pricing. And
Mhm.
so we had to build our own product and pricing rules engine under the covers in our analytics. And a really big part of that really had to do with speed. The industry right now, I think, is organized, and there's a lot of good pricing engines out there, but I think the way they think about things typically has to do with, oh, there's a loan officer on the phone with a borrower, and they're going to run 5 or 10 scenarios during that phone call, but that's kind of it. And so when you create a computer system that's designed for that, that's fine. But if you're going to run 10 million offers all at once, that tends to get a little more intense. And so, we couldn't really find a way to do that. We unfortunately tried some external services with APIs, and we took them down one afternoon. That was not a fun phone call for me to get. But the point being, we really kind of made peace with the idea that we needed to have our own product and pricing and rule set under the covers, and in that way, we're able to on a daily or even hourly basis when new pricing comes out, rerun a whole portfolio. So product pricing, eligibility stuff all happening, plus some of the other logic that you need for deal structuring, such as walking the escrow balance forward. And like I
Mhm.
said before, adding in the taxes and insurance, and also the fees that the lender is going to charge. And when you combine all those things into an engine that can run at scale, what you wind up with is, offers that are really very accurate. And so, yeah, a few of the assumptions that go into it are, of course, like you said, if this is still true, hey, you still have a job, still have some income that's roughly similar to what you had 2 years ago when you got this loan. Or the credit score. I mean, when we study this, we find that for the most part, if you had a 700 FICO and then you've been current on your payments for the last 18 months, you probably still have a 700 or maybe even a little higher. So using the origination credit characteristics and all the other things, you can make some reasonable assumptions and then let people tell you if that's not true. And then, then the idea being when you combine that with the message in the marketing message, it's not like a generic, hey, let's get you on the phone with this loan officer. It's like, hey, we really think if this stuff is true, we can help you lower your payment to this, or we can see that you have this much equity in your home. And so when you present that message, I think it seems to translate into engagement statistics for our emails and text messages. And when we show a message via API on someone's screen, that's really compelling. And so we think that people are really interested in, and what's the more information that I can get up front. And so that's a really big part of what we do, combining that with the outreach. And then the final part of our platform is a point of sale that we host that it's like everybody else's point of sale, but the difference is it's pre-filled with all the information from the servicing portfolio and the data. And so we've really tried to make that experience uh, pleasant from the standpoint of here's all the details that I can have. Wow, I don't get that from other people. And whoa, they've made it so I just have to click through and make sure that all this stuff is still right. And so, in that way, we've really tried to create a nice concierge experience for people, and it overcomes the scam factor because it's coming from a servicer. They already know that's real. Everything we do is white labeled for our customer. So, yeah, when we're working with ABC Mortgage, that's where the communication is coming from. That's what that point of sale looks like when they click on there. And so it's really meant to combine convenience and reassurance and help people feel like, wow, these guys are really, they're looking out for me. I didn't think that was out there. And so
Yeah.
that's the basic idea.
I think that's a key point when we think about, you mentioned customer experience a few times and like what the homeowner should think, does think, and can actually understand when once they click through and start the process of learning more about whether there's a deal there or not, that it is all organizing these different pieces, these disparate pieces of the lender bank's experience. And so if you kind of set it up that way to understand that I'm going to be helping out the recapture side, like you said earlier, offense and defense. I'm going to be helping out the marketing folks. They get to control it from a message brand look and feel perspective, but I'm populating it with that value. And then the consumer gets to see, I was just thinking, and we don't spend a lot of time workshopping new phrases on this show, but it's not even really a point of sale, right? Because they're already your customer and you're literally showing them something that'll save them money. And and I,
Well,
but
that's
they
true.
but they're going to go through an mortgage
Yeah,
application, and they're
that's right.
already, I don't know, 60-70% of the way through it, maybe even more
Yeah.
with existing data. And I think, it's hard to talk about what's next in this space without referencing the big Rocket Cooper deal, because that is
I
so.
heard about that.
Yeah, yeah. Well, yeah, that we do talk about on this show. But I think that the competitive landscape, what you're saying is also, it doesn't have to be this giveaway to the big players like that to say like, oh, they've got something I don't have. I think we would both agree, and we welcome any other perspectives on this, but I think we both agree that this doesn't just level the playing field. It can, in many cases, put you ahead because you can make these offers in real time proactively. And that is before they've even gone shopping. They being the customer has even
Yeah.
gone shopping. to a Rocket or to an online lead, spot for some calculator or some other daily rate. And I think
Yeah.
that's another piece. Timing is a huge aspect in the mortgage industry, and recapture is no different.
I think that's really right. Everything that you said, I'm tracking with. The only other piece I would say that
Mhm.
you were going through the list of people that are winning. The bank is winning, the consumer is winning, the marketing people are winning. I don't want to forget our good friends on the sales team who also changed
Mhm.
that phone call from "What are your goals, Mr. Potter?" That's an hour of their time, and you may not be able to even get the deal to, "Oh, it looks like you went through our process, and let's make sure this is the right deal for you." Obviously, we don't want to get you in the wrong product, but oh, it is. Okay, that's great. Now we can refer you down the closing path and, answer any questions. And so, but the way we see it, we've brought enough technology to bear that everybody is winning. And everything that you're mentioning, it makes sense to me. I mean, our good friends at Rocket, they have put recapture on the minds of a lot of people recently because at least with the stuff I was able to read about their logic on that deal was recapture is a big part of
Mhm.
the reason they wanted to get access to the Cooper portfolio. And I can understand all that. I think the other thing that I would say that we are really trying to do lately and I don't know all the things that the Rocket team has out there, but I can say that one thing we've really been trying to lead the way on is not only putting offers in front of people proactively, but also showing them a few of the different things that they could be able
Mhm.
to do proactively. And so we think about it. We have internally, we call it the loan navigator, which is the screen you kind of land on after you wind up seeing that marketing message and then clicking. And what we're finding is some really fascinating statistics about how people behave and come back over and over again to look at their options. And I think the only reason I want to point that out is because a lot of the time, what what at least the people I talk to in the industry think about it, recapture or really any kind of direct to consumer experience is, hey, let's get them on the phone with the loan officer. Like that's the marketing team's job. Got to get them on the phone with the loan officer. Loan officer takes it from there. And what we've really been able to organize our system around is some of the best research that we've seen out of Google and some of the other consumer behavior research out there talks about this idea of the messy middle, where it's not really a great strategy just to think of this interaction with a customer as a funnel where they start at the top and they drip to the bottom, and that's sort of the
Mhm.
end of the game. There's this moment in the middle where people say, "Well, I wonder if I could get a better deal. I'm going to quick Google a couple things and make sure that I'm not being an idiot here, like trying not to." And I think what we've been able to show is when you give customers an experience they can come back to a couple weeks in a row, a few times, and see the most updated pricing, see a consistent message about what was offered to them 2 weeks ago, they realize that the rate's not always going to stay the same, I think. But the idea is like, oh, we have some real flexibility in the products we can offer you. Like, oh, I mean, I'm using industry slang now. I'm not really a marketing person, but like you're going to put a cash out refi right next to a closed end second, right? And
Yep.
so, and give some advice about like what are the trade-offs here. And so we are seeing, at least in our data, and one way that we can help some of the smaller mortgage lenders out there compete in this era of clearly consolidation, at least for our good friends at the Rocket, is to be able to show these multiple products, provide a nice experience for people to come back to. To me, that's a new thing in the industry. Like an awful lot of people say, okay, let's create our digital experience to be okay. A loan officer is able to get a borrower to fill out their own loan application, but it's still let's get them on the phone with that loan officer because
Yeah.
that's the way sales happen. And what I can tell you is our data is showing that may not be exactly the case. In fact, people are willing to trade a tiny bit of rate sensitivity for, oh, they're telling me some stuff up front, they're making it really easy, this is really really helpful, and this is a company I already know, so I know it's not a total scam. And so that
Yep.
when you bring all that together, it is sort of interesting to think about uh, you know how you can harness some of the behavior of, okay, I'm going to start in the top of the funnel and then I'm going to doink around in the middle for a while there, doing my own research, coming back to it. Maybe I do, maybe I don't. And then if you can be there for people at that time, helping them, giving them a place to come back to that they trust. Well, I don't really want to put all my stuff into one of these lead generators. I don't know I looked at two or three other ones and I don't know if that's right. And then boom, I come back to the thing that was proactively shown to me last week.
Hmm.
Oh, wow. And then they're still here. They're still showing me the same stuff. And maybe their numbers have changed a little bit. What we're finding is that seems to be a really powerful approach. And one that, I mean, yeah, maybe not every 70-year-old mortgage borrower out there is going to behave that way, but as uh, mortgage borrowers get, you know, younger and younger, and more people who are used to dealing with technology come in and become customers, I think that's a really important way to look at it. And our numbers seem to bear that out. So that's pretty
Oh,
cool.
I couldn't agree more. I think you've really articulated well like what's next in this space, and that is this idea that if I give people an opportunity to see all these different options in real time with real data, I'm possibly the only one doing that. Because to be honest with you, it is about getting you on the phone with somebody who then takes all your information versus trusting that this is the spot you're going to keep coming back to
Yeah.
see, like you said, is it a closed-end second? Is it a HELOC? Is it a cash out refi? And I think for those customers, what I'm hearing, and I don't think anybody's doing this from a racket perspective or otherwise, is these are the same people who are helping their kids buy a house, who might be buying a second home or an investment property as well. And so as I think about what value is communicated, and I keep coming back. I mean, you mentioned I might be less rate sensitive because of the ease of use, which totally agree. I think every episode of Now Next Later, we have some aspect of that. Like we all do it in our own lives and then expect our customers won't do that, and we do it. So like, why wouldn't they? And then
Sure.
the other hard truth is, that you articulated, which I really like, is we'll get you on the phone. The salespeople are involved, but they're involved at the right time. And this
Yeah.
isn't some, what I would call, front edge, warm you up with a call center or an AI voice bot type of situation here. This is real data with a real customer who's interacting with it. And the analytics are only going to get better about who to call when. So that you're not
Sure.
getting 13 phone calls when you just were curious. You're getting one phone call when it matters. And I think
I think
those
that's
two
right.
hard truths are really, our industry's coming to terms with it right now, but I think you highlighted it really well.
Yeah. Well, thanks. Yeah, I think that's right. And the more we study the numbers, the more we see that is the behavior that people seem to want, is like, call me at the right time.
Yeah, right. Which
Well,
has
what's the
been
right
hard.
time? Yeah.
Yes, that's hard. And we're getting more data and we're getting more technology. So with that, Nate, this has been great. I think this is a really hot topic for people. We always try to end on a very forward-facing, future-facing question about, what's later. I'll keep it relatively open-ended, but it's hard not to talk about complex and sophisticated data analytics and customer interaction without talking about what do you build? Where do you go from here?
Yeah.
Obviously, AI comes up. Sure, it comes up in every conversation these days with everybody. But where do you see this going? What is your
Sure. Yeah.
our hope is, or our roadmap is taking us to this really far off goal? What would that be, and how much of that is tech?
Yeah, well, I think it's a great question. At Ardley, we like to say there's nothing artificial about our intelligence, and it's I don't,
I
whether
love
it's
that.
AI or not AI, I do agree that, the analytics that we try to build, and we've got a lot of really interesting things coming down the pike this year, that let our customers play with their analytics, even from the standpoint of like, oh, what happens if I change my margin assumptions? Like, could I be more aggressive right now? Could I not be more aggressive right now? I think those are really interesting possibilities. The other thing that I really would like to see us move toward, that I think is pretty interesting, is this idea that you could subscribe to your refinance. And so, when you could build in your relationship with a servicer and say, look, when I get to 50 basis points of savings, I want you to make it really, really cheap for me, but I can just count on you to do that and contact me when the time is right.
Mhm.
And it's, as the consumer, my end of things is going to be, I'm going to keep making my payments on time. And your end of things is, I want you to watch and just
Mhm.
let me know when the time is right. And maybe even give someone a way to say, well, I'm not going to do it if, the payback period isn't it's got to be less than a year or less than 2 years or whatever it is. But you let a person, give you that feedback and then be able to show them, oh, this is the right time. I think that's pretty interesting. I mean, coming from my world of Fannie Mae, I mean, I know that it would be even more interesting if mortgage-backed securities investors would let you just sort of turn the dial on the interest rate down. But I understand that's not really how the secondary market works. It would be
Yeah.
pretty cool if
Yes.
if you could hold the loans in your portfolio and you do just get to make changes. That would be pretty interesting because you could have the person really not redo a new loan. But um, barring that, even in a world where we do have to originate a new mortgage, I think it'd be really, I mean, I go back to this. There was a time it still sticks in my mind. Like 5 years ago, I got a refi and I was talking to the loan officer I was working with, and he was like, "Oh, there was a moment last week where you could have been at 275, for a,"
Yeah.
and I was like, "Why didn't you
Why
why
didn't you
didn't you
lock me
call
in?
me?"
Yeah, lock
Like,
me in.
why
Like,
are you
yeah, let's
telling me
go.
last week? Like, what are you, what, and like, if it was, I mean, there's a million things that go into starting a business, but it was still one moment that really helped crystallize to me, like the way that I want to think about this going forward with Ardley is, you know, I don't ever want to have that moment with some of my customers where someone's like, well, why in the world didn't you, didn't you let me know last week that I could have done this, right? I mean, so
That's right.
that's the mentality I'd like to create, I think, going forward. And I think we can do it.
That's a great vision in the future. And Nate, thanks again for joining Now Next Later. This was a perfect step-by-step Now Next Later of retention and potential for lenders and servicers to be paying attention to. So I know we'll have a lot of dialogue on this, and I can't wait to have you back and talk more about it as those things roll out. But thanks again for being here. It's great.
Yeah,
Great
it's great
conversation.
to see you. Thanks for having me. Okay.
All right, take care, everyone. Talk to you soon.